Hey guys, this video is just a follow-up to a video I had done this past spring on implied earnings moves and why they're usually wrong, and more often than not it's because the implied earnings move is far too simplistic and didn't account for the residual vol left after the earnings announcement. This video here I want to discuss the three distinct phases of trading earnings announcements. This chart here is a chart of Beyond Meat and their earnings announcement on July 29th, 2019 after market close. And this trading day here is the day right before the announcement. It announced after this, after the close on this day. Here's the gap, and here's the opening after the announcement. So phase one of trading earnings is the time period prior to the announcement, which might be a day or multiple days prior to it. There's no, it depends on all sorts of things, how many days, it might make sense to look at an announcement during this phase one period. Phase two is the gap move here between the day before the announcement and then the day after the announcement. Just that gap move is phase two. Phase three is the day after the announcement, after it opens, and either the day, that particular day, or the days following the announcement is phase three, which is, typically the volatility crush comes in after that. So oftentimes I hear people saying, or you see people saying that they're going to trade put on a trade that captures the implied volatility rip going into the earnings announcement. But the problem is that the entire world knows earnings is coming and has already accounted for that risk, and implied volatility is already juiced. It's just that the brokerage platform doesn't specifically state that because it just doesn't calculate options that way. So you have to, or at least I have to, go and manually figure out what the implied volatility is of an earnings announcement. I just did that with iRobot on the 30th of September. I placed this trade. It was the October 25th straddle that I bought. It was stock was around $60 a share. The straddle was trading at a break even of plus minus 16.5%, which seemed cheap. Captures earnings October 22nd. They reported after the market closed. Applies an earnings move of about 10% because I'm accounting for about 4 trading days. Well, sorry, 3 trading days. I have all day Wednesday, all day Thursday, all day Friday for iRobot to trade, and I figured 6.5% would probably be about what's remaining for a break even when it opens after announcing. So this 10% seemed low given 5 of the past 7 reports the stock gapped at least 12%. So I thought it seemed low. So I'm looking at this straddle on September 30th, and I'm like, man, I get to own this thing at plus minus 16.5% for the next 22 days, and I really don't see too much downside risk. Like, this thing isn't going to collapse to plus or minus 5%. It's not going to collapse to plus or minus 8%. I figured it would stay relatively bid at 16.5%. So fast forward a few days, October 9th. The at-the-money straddle remains the same at plus minus 16.5%. The stock dropped 12%. So I made no money off an implied volatility rip, but I did book a nice gain in absolute value deltas when the stock dropped 12%. So the straddle remained the same 9 days later after I put this trade on, but I didn't make any money in the implied vol because the straddle remained the same. So implied volatility actually went up because there were 9 days less. So the only way to keep the straddle at 16.5% while subtracting 9 days from the time that the straddle has before expiration is to increase implied volatility. But it really doesn't help me because that break even didn't change at all. So the only way for me to make money was an absolute value delta gain. So I hope that makes sense to people, because there's a big difference between those two things. And we can see that going to this calculator here. So I put this thing on 25 days out. Implied volatility was somewhere around 79% when I put it on, which gets me to about a 16.5% break even here. The only way to end up with a 16.5% break even, going into that announcement, because we have 4 days out, can't keep volatility at 79%. It cuts it more than in half. So the only way to get back up to that 16.5% break even is to increase implied volatility to something like 190%, which gets me back up near that plus minus 16.5% break even. So yeah, implied volatility does rip going into the announcement, but just because implied volatility rips, better than 100%, from 78% or 79% up to 190%, doesn't mean that I'm going to make any money if I own the straddle. So I have to go and figure out exactly what the implied volatility is going into that event. So it takes, just like with the implied earnings move, and how that's too simplistic, purchasing a straddle because implied volatility is going to rip higher is far too simplistic as well. More work needs to be done to see whether or not a straddle is worth buying or not going into that announcement. So I actually looked at that Beyond Meat, and this straddle was trading at about plus minus 16% a few days out before the announcement, and this was the 170. The stock was trading right around 170 at the time, and it was going for about plus minus 16%. Then the stock just ripped up to like $240 a share, and the straddle went from being worth $28 to being worth $70, which is just 100% gain in the straddle. But that was all pretty much all delta related, which you can see here. So we have that rip from 170 up to 240. So you have like a $70 gain in the straddle as it is. Just in the share underlying is a $70 gain. So that's pretty much strictly a delta gain at that point. And then here's the straddle into earnings. So you can kind of see the stock's not really moving much. The straddle's just kind of staying somewhat flat going into the earnings announcement, and it actually gapped down pretty good. It was trading around 220, then it opened around 190. So the implied volatility was still relatively big. So the straddle, this isn't the worst long straddle I've ever seen into earnings, because the crush wasn't too bad. So even though the stock dropped $30 on the $40 straddle, this thing still lost money. We can go back and look at this thing. So it closed at just about 220, and it opened at just about 190. And then this thing just proceeded to lose money for the first 3 hours of the day, and then ramped higher as the stock, I think, ramped from 190 up to 220. But getting back, this is why there's 3 different phases. Like, if I'm buying the straddle prior to the announcement, looking for a gain prior to the announcement, that's why it's phase 1. If I'm holding it through the announcement, now it's become a completely different trade, because implied volatility is going to drop. The only way for me to make money is to make money from a gain in deltas on either a gap much lower or a gap much higher when I hold that straddle. So it's a completely different trade than buying the straddle prior to earnings and looking for a gain in either implied volatility or a gain in delta. And when I say a gain in implied volatility, I mean an increase in the break-even price of that straddle. And then the third phase is, afterwards, which is just, I suppose, wishful thinking if you're still holding on to the straddle, hoping to, crawl your way back to, or, if I'm holding it, hoping to crawl my way back to break even, which isn't really a strategy. So that's why there's 3 distinct phases here, and this is just the post-earnings straddle. So this is where the straddle opened after the announcement. So the this is the morning. Right here is the first 5 minutes of trade or so of after the announcement, and the at the money 190 straddle, and you can see this thing just kind of drops off a bit and then rips higher as the stock rips to 220, and then just collapses as the stock comes back down to close right around 190 again. Then you can kind of just see how these were all delta gains. The rest of the week is just gains in delta, or from there's no implied volatility. Is just going by the wayside as each day goes by. So any gain that you see here is from a gain in delta, and that's it. Following that gap earnings announcement. So those are the three phases, and something to consider as far as like gap moves and break evens go is considering and talking historically about stocks. People will say, well, you know, the stock historically has moved, you know, 6% or 8% or whatever, but one of the big problems is here's Constellation Brands, and I just have their you know, earnings dates changed into days of the week, so they always report before the open, and some of the problems arise too. A lot of the companies will trade after market close and before market open, so that needs to be taken into account because it throws off the residual vol calculation for the straddle. But you can see here, you know, sometimes they report on Wednesday, sometimes they report on Thursday, sometimes they report on Friday. So that there's a big difference between reporting on before the market opens on Wednesday than there is before the market opens on Friday, because this just leaves you 6.5 hours of trading. If you're buying that options, if you're buying that expiry this Friday, this expiry for this Friday, you know, the 28th, that gives you 6.5 hours after the announcement of residual volatility. Whereas Wednesday, you have all day Wednesday, all day Thursday, and all day Friday. So you have, you know, all that extra time, and that needs to be accounted for when figuring out break evens on the straddles is what's left. So this is just, you know, I'm speaking quickly. There's a lot to cover. I could literally go on for hours talking about straddles and strategies here. So this is just a quick little thing on the three phases of trading earnings, and that's prior to the earnings, leading up to the earnings announcement, and then trading through. There's just so much ground to cover for each phase, but this is just a general overview of you know, what to expect. And yeah, implied vol does rip up, but you know, a lot of times the straddle will compress. The straddle will be declining in value because while implied volatility is going up, the actual implied move or the break even is declining in value. So the only way to make money is by increasing deltas, which is what you know, Beyond Meat just ripped going into its announcement. So there's a lot to consider here, and much like with the implied earnings moves on my past gap video, if there's any consistent rule when it comes to options, anything that's simplistic is probably wrong. So anything, if you ever hear anything, oh, it's simple, or this is simple, or that's simple, or this strategy is simple, it's probably wrong, or the person's missing something. Like, it's just wrong. There's a lot to it. There's a lot of moving parts. And this is just stuff to consider. So I hope this video helps somebody out. Again, like, I could speak just about the, you know, phase one portion of this. I could probably talk about that for hours. I could probably talk about the gap moves for hours. I could probably talk about the time period afterwards for hours. But I just want to put this video together quickly and hopefully it helps somebody out there and makes a little bit of sense. I certainly hope that I didn't confuse anybody too much, but options aren't exactly the most intuitive instrument to trade, especially straddles and implied volatility, and how volatility changes, and you know, in dealing with that aspect of the trade. But again, I just hope it helps out, and if anybody has any questions, you can shoot them at me, and if I have the time, I'll try to get back to you. Take care.